Welcome to Earnings Recap. Today we're covering Walmart's fiscal 2026 first quarter earnings report and call.
And we've got quite a bit to unpack here.
We do. And, something really interesting came up on the call. Over 475,000 Walmart associates are actually participating in their share purchase plan.
Wow, that's a huge number.
It is. And get this, 81% of them are hourly employees. That feels like a pretty strong signal, doesn't it? Shows real buy-in from the ground level.
Absolutely. It suggests, a strong alignment. People believe in where the company's headed if they're investing their own money.
Right. So for this deep dive, our goal is pretty simple. We're going to take all that information from the earnings report and the call and boil it down.
Yeah, summarize what really matters in plain English. Cut through the jargon.
Exactly. So you get a clear picture of how they did and maybe what it means going forward.
We'll hit the key results, what's driving them, and maybe some of those less tangible things we picked up too.
Okay, let's dive right in then. First quarter, fiscal 26, Walmart reported revenue growth of 2.5%.
Which sounds okay, but it's better when you look at constant currency that bumps it up to 4.0%.
Good point. And they did mention a bit of a headwind there, about 1%, because they were lapping the leap day from last year.
Right. That extra day last year makes the comparison a little tricky. It affects the percentages.
Same story with operating income, reported up 4.3%, but adjusted in constant currency, it's 3.0%.
And that leap day had an even bigger impact there, didn't it? Something like a 2.5% drag.
It did. So yeah, even with those calendar quirks making the numbers look a bit softer, the actual business seems to be moving well.
Definitely looks like healthy underlying momentum.
Okay, profitability. GAAP EPS was 156 cents. Adjusted EPS came in at $0.61.
And that adjusted figure just pulls out a net loss on some equity investments, so one-off thing.
Right. But here's what really stood out to me. They specifically said the strong quarter came from more transactions and more units sold.
Yeah, not just inflation pushing prices up. More people buying more stuff.
Mm-hmm.
That's pretty significant in this environment.
It really is. That's a key difference. And importantly, the bottom line was actually better than they expected.
Which points to, good execution. Maybe the consumer is holding up a bit better than some feared. Overall, a good start to their year.
Agreed. A solid Q1. Seems like the changes they're making, their current position, it's working.
A lot to like there.
Now let's talk about e-commerce. That was a real highlight. Global e-commerce sales were up 22%.
22%, that's huge. And it wasn't just one area carrying the load. They said every segment saw at least 20% growth.
That's pretty amazing. Shows that digital strategy is really firing on all cylinders globally.
It really underscores how they're meeting customers wherever they want to shop.
Okay, but here's the kicker. For the first time ever, Walmart hit profitability in e-commerce in Q1.
Wow, okay. In the U.S. and globally.
Yes, both. Although they did say international was just slightly unprofitable, but still a massive milestone.
That is huge. After all those years of investment, finally seeing it turn profitable, that's a big signal for the whole industry, really. Shows it can be done.
Totally. They pointed to a few things driving that U.S. profit. One was densification of the delivery network.
Right, basically getting more efficient with delivery routes, packing more deliveries into smaller areas, lowers the cost per stop.
Exactly. And related to that, lower unit delivery costs overall, thanks to supply chain improvements.
Makes sense. And weren't customers also paying more for speed?
Yes. They mentioned customers being willing to pay for those really fast options like 1 hour or 3 hour delivery.
And those super fast deliveries, the sub 3 hour ones, they grew like crazy, right?
Yeah, 91% year over year in the U.S. That really shows the demand for immediacy.
It definitely feels like all those investments they've made over the last, decade? The single app, the fulfillment centers, linking stores and online.
Mm-hmm.
It's all coming together now.
For sure. And just the flexibility they offer, shop in store, curbside delivery, in-home delivery. Giving customers all those choices seems key.
That flexibility is definitely a competitive advantage.
Okay, let's shift to the segments. Starting with the big one, Walmart U.S. comp sales, excluding fuel, up a strong 4.5%.
Nice. And again, driven by more transactions and more units sold. So more people shopping and buying more each time.
Health and wellness was a standout high teens growth. Think prescriptions, over-the-counter stuff.
Mm-hmm. And grocery.
Grocery was solid, too. Mid-single-digit comp growth, and they're still gaining market share there.
Reinforces their role as that go-to for essentials.
General merchandise was a bit softer, though. A slight decline overall. Things like electronics, home, sporting goods were weaker.
But they did sell more units in general merchandise, even if the dollar amount was down slightly.
Correct. So maybe people are being more careful with discretionary spending, but still finding value at Walmart for those items.
Interesting distinction.
U.S. e-commerce, as part of this, grew 21%. That added about 3.5 percentage points to the total comp sales figure.
Significant contribution.
Yeah.
And how about margins in the U.S.?
Gross profit rate actually improved by 25 basis points. They credited good inventory management and a better business mix.
That's positive, likely helped by that e-commerce growth and maybe selling more higher margin items.
Yeah. Operating income in the U.S. was up 7.0% or 4.4% adjusted. And one other small point, private brand grocery penetration up 60 basis points.
So their own brands are gaining traction, people opting for value, likely.
Okay, let's hop over to Walmart International. Net sales looked down 0.3% reported.
But the currency effect again, right? Constant currency tells a different story.
Exactly. Up 7.8% in constant currency. China, Flipkart in India, Walmex in Mexico were the leaders there.
So underlying international business is actually quite strong, despite the currency headwinds.
International e-commerce also grew nicely, up 20%. Operating income, though, took a hit, down 17.5% reported.
Or down 6.4% constant currency. Why the drop there?
Primarily strategic investments. They're pouring money into growth initiatives for Flipkart, Walmex, and Canada. So spending now for future growth.
Okay, so prioritizing market share and long-term position in those key markets.
Seems like it. They also mentioned better delivery speed internationally, same, or next day, up 35%, and almost half of those were under 3 hours.
Wow, so that focus on speed isn't just a U.S. thing. They're pushing it internationally, too.
Yep. Lastly, Sam's Club US. Another strong quarter there. Comp sales, ex-fuel, up 6.7%.
Very solid, driven mainly by more member transactions.
E-commerce at Sam's was even hotter, up 27%. They called out triple-digit growth in their club-fulfilled delivery.
Interesting. And membership income, still growing.
Yep, up 9.6%. They said member counts are up, renewals are strong, and more people are opting for the Plus membership.
That recurring revenue stream is so valuable, and it shows the club model is still resonating.
And get this, over half of Sam's members now use digital channels in some way. Plus, it was their fourth straight quarter of positive general merchandise sales, driven by units again.
So Sam's is seeing strength across the board, including in those non-food categories, and members are really embracing digital. Good signs.
Definitely. Let's talk margins and costs overall. Consolidated gross margin rate ticked up slightly, 12 basis points, mostly thanks to that U.S. improvement of 25 basis points.
Right, driven by that inventory management and mix shift we talked about in the U.S.
SG&A costs, though, selling, general admin expenses, they deleveraged slightly by 6 basis points. So costs grew a tiny bit faster than sales.
Why was that? Didn't they have some costs last year that made the comparison easier?
They did, yeah. They were lapping a reorganization cost from last year, which helped a bit. But International and Sam's Club US saw deleverage mainly from planned wage investments.
Okay, investing in their people.
Right. And Walmart US deleveraged a bit too, due to higher depreciation and, interestingly, the operating costs from acquiring Vizio.
Ah, right. The Vizio deal impact is starting to show up. They also mentioned higher casualty claims.
They did, yeah. Higher than expected costs from things like accidents, insurance claims, something to maybe keep an eye on.
Okay.
Now, those newer businesses, advertising huge growth, up 50% globally.
50%. Mm-hmm. Now, that includes Vizio, doesn't it?
It does. But even taking that out, Walmart Connect in the U.S. was up 31%. Still really strong.
That's impressive. It shows how well they're monetizing their shopper data and website traffic. It's becoming a serious business for them.
Absolutely. And Sam's Club ads were up 21%, international ads up 20%, led by Flipkart. It's growing everywhere.
And membership income across the whole company?
Up 14.8%. Sam's US was up almost 10%. Walmart Plus saw double-digit growth. Sam's Club China was up over 40%.
Wow. Those advertising and membership businesses are really becoming significant profit drivers, aren't they? They mentioned it's like, what, a quarter of their profits now?
Around that, yeah. It's a major diversification away from just relying on selling stuff.
A huge strategic shift.
Yeah.
Okay, what about inventory?
Inventory was up 3.8%. They said that's a healthy level. They feel good about it.
Okay. But I know they spent a fair bit of time on the call talking about tariffs.
Oh, yeah. That was a big topic, especially tariffs on goods from China. It's clearly a challenge.
They're feeling the cost pressure already.
Yes, they said it started in late April and picked up pace in May. They laid out their strategy to manage it, though. It's multi-pronged.
Like what? Keeping food prices low.
Yeah, trying to protect value on essentials like food and consumables. Also, looking to shift production away from China where possible.
Okay. Absorbing some costs themselves, too.
In some categories, yes. And managing the product mix, working with suppliers to find materials from non-tariffed countries, basically pulling multiple levers.
It's complex, but didn't they also highlight how much they source from the U.S. already?
They did. Over 2/3 of U.S. sales are from products made, assembled, or grown domestically. That was almost $300 billion last year.
Wow. And they have that commitment to buy even more U.S. goods over the next decade, right?
Right.
The $350 billion incremental target.
Correct. And they mentioned their Grow With Us program to support U.S. small businesses, which ties into that. It's partly a hedge against tariff risk, you'd think.
Makes sense strategically. So longer term, they hope tariffs come down, but they're preparing for them to stick around.
It seems that way. They were pretty clear that even if tariffs are reduced, higher tariffs likely mean higher prices for consumers eventually. The timing of when tariffs hit versus when they receive inventory is also a big variable for their quarterly results.
Right. And the CFO, John David Rainey, he went into some detail about their accounting, didn't he? The retail inventory method, or RIM, in the U.S.
He did explain how changes in inventory prices can cause markups or markdowns that swing quarterly profits around a bit. Makes forecasting harder with tariffs bouncing around.
Yeah, it creates that lag or lead effect. And he mentioned LIFO at Sam's Club, too. Potential charges there if inflation continues.
Exactly. If prices keep rising, the last in, first out method could mean Sam's Club reports higher costs, potentially hitting their profit.
So these accounting details really matter when you have big external shocks like tariffs hitting the system.
Definitely highlights the complexity. It means short-term results can be a bit bumpy, even if the underlying business is okay.
Makes sense.
Okay, so what about their outlook? Their guidance for the future? Did they change anything?
For the full year, fiscal 26, they actually reiterated their guidance from back in February. No changes there.
So they're still expecting net sales, constant currency, to be up 3.0% to 4.0% for the year.
Correct. And that includes about a 0.2% tailwind from Vis.io, which basically cancels out the headwind from lapping the leap year.
Okay. And adjusted operating income, constant currency, still expected up 3.5% to 5.5%?
Yep, same range. That includes a roughly 0.8% drag from Vis.io, again, sort of offsetting the leap year benefit on the cost side.
Got it. And adjusted EPS still $2.50 to $2.60, factoring in about a nickel headwind from currency. CapEx around 3.0% to 3.5% of sales.
So, yeah, despite all the noise around tariffs and the economy, they're sticking to their full-year plan. That shows some confidence.
It does. They did give specific guidance for Q2 sales, though, forecasting a 3.5% to 4.5% increase in constant currency.
Which, again, includes that small Vizio tailwind. And Q2 last year was, what, about $168 billion in sales?
Yeah.
So still guiding for decent growth.
Right. And this is important, they didn't give specific operating income or EPS guidance for Q2.
Ah, interesting. Why not?
They basically said things are too uncertain right now. The tariff situation, how it flows through with that RIM and potential LIFO accounting, it makes forecasting the Q2 bottom line really difficult.
Okay, so they're being cautious short term. They suggested looking at Q2 and Q3 together, maybe?
Yeah, think about the next couple of quarters in aggregate was the message. But again, they stress confidence in hitting the full year numbers.
So acknowledging near-term fog, but maintaining long-term visibility. Understandable.
How about capital allocation? Where's the money going?
Well, CapEx, as we said, 3% to 3.5% of sales, probably towards the higher end.
Yeah.
Still focused on automation, stores remodels, and some growth in tech. Long-term return focus.
Standard stuff there. But they were pretty active buying back stock in Q1, weren't they?
Very active. $4.6 billion in share repurchases. That's more than they did in all of last year.
Wow. Why so aggressive?
They said they felt the stock price was dislocated, basically undervalued, and they have strong confidence in the business, so they saw an opportunity.
And they'll keep being opportunistic going forward.
That's what they indicated. Balancing buybacks with dividend growth and that CapEx plan shows belief in their own stock value.
Okay. What about the customer? Any insights on consumer behavior?
They said customers are still being choiceful, is the word they used, looking for value, prioritizing speed. But they saw growth across all income groups in Q1.
So not just lower income shoppers driving growth?
No, growth across the board. April was apparently particularly strong, helped by Easter timing. Suggests Walmart's value prop is appealing broadly right now.
And Sam's Club, too, resonating across income levels.
Yeah, they feel a curated assortment and the convenience factor at Sam's works well for different types of members.
Makes sense. So wrapping up their strategy, what are the big themes?
Omnichannel is still front and center. Better assortment, faster delivery, scaling those newer businesses like ads and membership.
Creating that seamless experience however you shop.
Exactly. And diversifying where the profit comes from, e-commerce marketplace, membership, advertising, that's clearly a huge priority.
They also made a point of mentioning treating suppliers well, which is interesting.
Yeah, maybe especially important with all the supply chain pressures and tariff issues. Maintaining good partnerships. And continued investment in automation, stores, tech.
So putting it all together for Q1 sounds like strong results, really driven by traffic and e-commerce finally turning that corner on profitability.
Yeah, transactions and units driving the top line, e-commerce hitting profitability, and those newer ad and membership businesses really starting to contribute significantly to the bottom line.
And they seem to be navigating the tariff complexities, expressing confidence in their strategy and the full-year outlook despite the near-term uncertainty.
Absolutely. That focus on omnichannel and diversifying profits seems key to both the current results and their confidence going forward.
Okay, so let's leave our listeners with something to think about. We've talked a lot about tariffs, the economy, consumer behavior, but considering Walmart's sheer scale, its deep entanglement with global supply chains, what other, maybe less obvious factors could really shape their future?
Good question. Beyond the usual suspects, maybe think about disruptive technology shifts. Like, how could AI truly transform retail operations or customer interaction at their scale?
Or maybe evolving consumer values, increased focus on sustainability, ethical sourcing. How does a giant like Walmart adapt to those potentially faster than economic cycles shift?
Right. Or even major geopolitical realignments, shifts in global trade patterns beyond just tariffs.
Yeah.
How resilient is their incredibly complex global model to those kinds of shocks? Lots to ponder there.